Welcome to Chapter 6, Market Efficiency Theory, or as I like to call it, who can beat the market? Can anybody beat the market? We'll see. In this chapter, we'll discuss what is called efficient market theory and the random walk and the various forms of it, and see if indeed there is anything that we can actually learn from it. And it turns out there is. There is some things that we can learn about investor psychology and how we as humans react in the investment world and other parts of our civilization and our lives. We will then revisit the active versus passive management controversy and end with some discussions of some of the people who can beat and have beaten the market over decades, are all-stars of investing, and then also throw in a few famous myths and stupid sayings. So let's get started with a couple of quotes from one, Sir Isaac Newton, who said, "I can calculate the movement of the stars, but not the madness of men." And what was he referring to? He was referring to financial picadillos of the time. Nothing, I mean, the technology changes, but we humans haven't changed. It was the South Seas adventure where people just thought they were going to get rich, rich, rich. It sound familiar? And didn't work out so well for Sir Isaac Newton and a whole lot of other people at the time. We're basically the same. The technology changes, but we're still looking to get rich quickly. So NFTs, anyone? Cryptocurrencies? Benjamin Graham said it best when he said, "The investor's chief problem, and even his worst enemy, is likely to be himself." Now, of course, we would say his or her worst enemy now, likely to be himself or herself, but same idea. We are all, when it turns out to investing, our worst enemies if we choose to follow the crowd, to quick, they're giving away free money, get down there. Slide number 2. The efficient market hypothesis states that a market in which securities reflect all possible information and act quickly and accurately, and there are a large number of knowledgeable investors, prices will quickly and accurately adjust to reflect all new information. So what's an example of an efficient market? Well, you got plenty of sellers, plenty of buyers, the New York Stock Exchange, the NASDAQ, the various large London exchanges around the world, London, Frankfurt, Japan, now in other parts of the world where they have plenty of buyers, plenty of sellers, and plenty of good regulations to make sure that hanky-panky doesn't happen, unlike cryptocurrencies and NFTs. So in other words, the price that this thing is selling for right now is the accurate and precise and efficient price that it should be. Along with the efficient market theory and hypothesis comes the random walk theory. And it's a theory that stock price movements essentially are unpredictable. In the short term, they are random. Well, this has been proven. It is true. In the short term, they are random. But in the long term, oh no. We go back 200 years and we see that as not the information age, that's what we're coming into, but the industrial age came, we saw the standard of living increase exponentially, hundreds fold, to the point where somebody woke up from the 1800 and woke up to 2020, they would just be, they'd be gobsmacked. So, of course, the stock market has responded and companies have become have created incredible wealth. And so some people say, well, you know what, this can't continue. And they're right, growth can't continue indefinitely. But we still have a whole lot of people that are living on $1 or $2 a day worth of output. And they barely have access to clean water and good food and a house over their head and internet access, of course, food, clothing, and shelter, and internet, the four things that we need to survive. So we have a long way to go. The trick is, we'll see how well we do, is to do this sustainably and such that everyone is included. No one's left out. So we'll see how well. Nothing's perfect. Not capitalism, certainly. So, in fact, you might have heard it. Capitalism might be the absolute worst economic system ever created, except for all the others. Slide number 3. What happened? The efficient market theorists started in the late 60s, early 70s, 1970s, and at that time, the physicists were coming up with their theories eventually called the Standard Model. And they used weak and strong in their theory, so it spilled over into the efficient market theorists who saw that, look, some of these people who are supposedly are professionals and supposedly know what they're doing are not doing any better than if we just threw darts at a dartboard. So there's got to be a reason why. They come up with these various forms of the efficient market theory. And the first one is the weak efficiency hypothesis. And this says that past data on stock prices are of no use in predicting future prices. Stock prices do tend to demonstrate momentum. Stock prices tend to rise more often than they fall because the global economy is getting larger. And they tend to move far higher than is usually justified. This is often called a mania or a bubble. Or far lower than is usually warranted, a crash or a panic. And in it was 1950s, as I remember, the story goes that there were a group of sophisticated investors who were shorting the market because they were absolutely convinced, and it turned out they were right, they were just too early, that the prices were overblown. We were in a bit of a mania, a bubble. Stocks were overvalued. And they were complaining because they were doing something called shorting, which we'll discuss way at the end of the semester, which I hope you never do because it's pretty darn dangerous. But they were betting that the prices go down, and they were getting creamed. They were losing tremendous sums of money. And they complained to Sir John Maynard Keynes, the famed noted economist who helped the world get out of the Great Depression, that stock prices were just irrational. And he famously quipped, "The market can stay irrational longer than you can stay solvent." And this is absolutely true. When people do bet against the market going up, they can literally lose their shirts very quickly. And we'll see that, but not until the end of the semester. And if this theory is true, then technical analysis is useless. And we'll cover technical analysis in our next chapter. We've been discussing fundamental analysis. We'll come back to technical analysis later. The next form is the SemiStrong efficiency hypothesis. And they posit, which is a fancy word for they say, abnormally large profits cannot be consistently earned using publicly available information. In other words, no amount of analysis that you do to determine the future price of a stock will help you beat the market. That means that the fundamental analysis that we did in the previous 2 chapters is useless, right? The problem with this theory is that there are many, many investors who have, and we're going to look at some of them later, the AllStars of Investing, and they're not the only ones. And so the theory has a problem, right? They say that nobody can beat the market, but there are people who do. So what does the theory say about those investors? Oh, they're just lucky. There's a famous quote, the more I practice, the luckier I get. And the story goes something like this. You choose the golfer, it's attributed to several, did a really good job and beat everybody else and won the tournament or whatever. And a reporter said, "Boy, you were really lucky out there today." And the golfer said, "You're absolutely right. And the funny thing is, the more I practice, the luckier I get." Practice makes perfect. And we've already said that there's going to be times where we're going to make mistakes, but that's okay, because if you can go out there and on the best of your days, hit that ball, that little white ball, 300 yards in 3 shots, and do it consistently. And there's going to be days when you have horrible, or you throw the golf clubs into the water. But no, you're going to make a lot of money. If you can hit a fastball at 100 miles an hour 3 times out of 10, you're going to make an awful lot of money. If you can sing a 4-hour opera in front of thousands of very critical individuals in the audience, because they spent a fortune to watch the opera, and have them screaming and hollering and bravo and clapping, you're going to make a lot of money. And so not everybody can do that. I certainly can't, but there are people who can, and we'll see some of them. Not the opera and the sports stars. We'll see the investment stars. And then the last version of the market efficiency theory goes like this. It's the strong efficiency hypothesis. No information, public or private, allows investors to earn abnormally large profits consistently. But one insider information trade can make you rich overnight, instantly. If you don't get caught, that is. This is obviously false. Obviously false. If you had what the legal term is material non-public information, that's the legal term for insider information, about a company, you can make a fortune overnight. But you can also go to jail. And this is what happened to the celebrity Martha Stewart. And I always patted myself on the back for not even knowing what she looked like, because I don't want to know what these celebrities are all about. Turns out Martha Stewart used to be a stockbroker. She knew exactly what she was doing, and she dated a guy who was the CEO of a drug company, and he knew that his drug was going to be denied by the Food and Drug Administration. So he started selling his shares. Both Martha Stewart and her ex-beau, the CEO, had the same stockbroker. So the stockbroker goes to Ms. Stewart and says, Sam, I think is his name, Sam is selling. So she starts selling. Well, what they both did, and the stockbroker who helped them, was illegal. They committed insider trading. He went to jail. The CEO went to jail, I think, for 7 years. She and the stockbroker tried to come up with this cockamamie excuse that they had a stop. Remember we talked about the stop loss transactions? Well, she used to be a stockbroker. She knew that wasn't going to work, because if you do have a stop, it's going to be recorded somewhere in the computer system or on paper before everything went to computers. So I think, I don't know, I'm not going to ask her, that she did it on purpose. She knew that she's going to do, they told her, you're going to do, 4 or 5 months in jail, but think of the publicity. You can't buy that publicity. They're going to have you on TV showing the inmates how to cook a turkey, and the woman's a shark. Anyway, don't do it. This is obviously untrue. If you have insider information, material, non-public information, you could become very wealthy if you don't get caught. So, the efficient market and random walk theorists are often also major proponents of index funds. They point to the fact that many professional money managers simply do not beat the market, especially during bull markets. From 1963 to 1998, the S&P 500 index outperformed general equity mutual funds 22 out of 36 times. They reason that you're better off accepting close to the market's return. Remember, you can't get the market's return because there's some fees, except for those Fidelity, few Fidelity index funds that don't charge anything. They reason you're better off accepting close to the market's return with low-cost index funds, since their theory tells them that no one can consistently beat the market. Why can't many pros beat the averages? Well, it's a serious issue that we need to address. Many mutual funds have high annual operating expenses and high turnover rates. And many mutual fund managements have very short time horizons. Consequently, many mutual fund managers have a very short lifespan. And this is changing. This was the model that Fidelity and the old guy from Fidelity, Johnson, Mr. Johnson, said, look, these people have to perform. And if they don't, oh well. So within a couple of years, if you had not done very well, you were out the door. Well, these people are not stupid, right? They're the best and the brightest coming out of the business schools. Here you are, kid. Here's $1 billion. See how you do. And so they knew that if they just, were average, they were going to get kicked out. So what would they do? They would try to juice their returns by higher risk transactions, often buying and selling. Because they figured, okay, well, if I do well, I get to stay and get showered with love and attention and a whole lot of money. But if I don't do well, oh well, they were going to kick me out anyway. Now, this is obviously not in the best interest of the shareholders. So many companies, and now more and more companies, have always had a longer term approach. They gave their money managers 4 years, 8 years time frames and see how they do. And now, obviously, that because of their success, other companies are following it. So, but the premises and the casual observations of the efficient market theory show them to be patently absurd. Many money managers have beaten the market over statistically significant periods of time. The more I practice, the luckier I get. Plus, if markets are efficient and rational, how do you explain manias? How do you explain bubbles? Occasionally, investors get caught up in what are called manias. We also call them bubbles. The internet bubble of the 1990s was the latest stock mania. Now, some people say we're in a bubble right now, and in a stock bubble. For some stocks, I will agree. There are many stocks that just look overpriced. But then you look around and there's some that are, not, this is reasonably priced, and, their growth prospects look pretty good. So I don't think it's as bad as it was in 1999, but it's still not good. I think the bubble right now is in crypto and NFTs and meme stocks, whatever that means, just stocks that a large group of people. You see, that stuff that's going on Reddit, it's Reddit, right? If you did that with 5 or 10 people, or maybe 2 or 3 people, you get caught, you go to jail, what they're doing. But because it's 1 million people, what are they going to do? I don't know. It's like a syndicate that used to be legal before the crash of 1929, where people would get together and say, "Okay, come on, we're gonna pump up the price of this stock, all right? And then after it's pumped up a while, we'll sell it." It's called pump and dump. It's been around for hundreds of years, and now it's illegal, right? You can't do that with 2 or 3 people. But if you have 2 million people on the internet all around the world, so are we in a bubble right now? I think so with regard to cryptocurrencies. And if you look at a cryptocurrency called Tether. I've been reading about it. I keep calling it Tender. No, not Tinder. Tether. It's based in the Bahamas or Bermuda or Bhutan or one of those places that starts with the letter B, and they have no regulation whatsoever. The banking system there says no, we don't touch these people. Uh, so I'm pretty sure that it's all smoke and mirrors. They've either squandered the money, in which case that would have been you know a Ponzi scheme where they didn't actually invest it, or they invested it in very, very dubious things, such as more cryptocurrency, because this tether is supposed to be backed by dollars, and they say they are, but they won't show they won't show the investments. So that to me means, oh yeah, cryptocurrencies are going down. I don't know when, but it's going to happen. Before that, before the internet bubble, there was the Nifty 50 of the early 1970s. These were stocks that no matter how high the price went, it was okay to buy them, like Calcomp and Tektronix. Where are they now? Metro Media, you hear that one? And then the famous one was Polaroid. Right, Polaroid. I don't know, folks. I would never want to invest in a company whose name rhymed with hemorrhoid. It's just, I don't think it's something. Ended badly. It ended badly with the crash of 73 and 74. The mania of the 1920s resulted in the crash of 1929. You might have heard of a company called Radio Corporation of America. You know it as RCA. Lost 99 point something percent, 99.8%. In the 1840s, there were 400 railroad firms. There's less than a handful now. But the granddaddy of all manias was the Dutch tulip bulb craze of the early 1600s. And there's some controversy about exactly how extreme the bubble was, but it was a bubble. One tulip bulb would sell for an ungodly amount of money. And the thing about tulip bulbs is when you put them in the ground, they make more tulip bulbs. And so obviously that wasn't going to last. And it's described in a couple of really good books that you could read, because reading is cool. And you can get them on your cell phone. You don't actually have to go to the library and check them out. You can go to the library on your cell phone and download them. Reading is cool. Extraordinary Popular Delusions and the Madness of Crowds. And this book was written in 1840, but it still is shocking. It goes through the history of the one that Isaac Newton was hit by. It goes through the witch hunts, the witches, and the crusades, and things that just were totally, totally insane. But one of my students said it really well. It's easier to fool 1 million people than it is to fool one person. Yeah, in crowds, there is madness. Right now, they're all on Facebook, Farcebook, Fleecebook. Then there's another wonderful book called The Botany of Desire, which is a little dated now. Technology's changed. But this gentleman is really, Michael Pollan, he's really sharp. He goes through the relationship of humans to plants. And we think we're in charge of the plants, right? But he goes, no, you don't understand. The plants are in charge of us. They get us to feed them and plant them and keep away their bugs and their enemies, and they got a great deal going. These humans are pretty cool. So check it out. And every time the phrase was, it's a new era. It's different this time. The old ways of valuing stock are gone. Ooh. Is it too late to get in? And each time, dear students, they were wrong. So much for rational, efficient markets. Why do manias occur over and over again? Why haven't investors learned their lesson? Any ideas? Well, here's Leonard Kaplan, the president of the commodities brokerage firm Prospector Asset Management in Evanston, Illinois. And he said, and I think he sums it up very well, market manias will happen over and over again because the public is infinitely stupid. Benjamin Graham said it a little more terse. Yes, Benjamin Graham is the intelligent investor. He's a little bit more flowery in his language and sometimes a little opaque. But he says it well here. The speculative public is incorrigible. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you, when the particular fashion is raging. The abuses are so largely the result of the public's own heedlessness and greed. Now, Ben wrote this in 1972 in his last edition of The Intelligent Investor. He passed away in 75. But those were the technologies of the time, the computers and electronics and science, CalComp, Tektronix. Franchising companies were really big at the time, and some of them have survived, like McDonald's, and most of them are disappeared. You replace franchising, computers, etc., with internet biotechnology, and good old Ben could have been writing in 2000 instead of 1972. And today, the buzzwords are cryptocurrencies, meme stocks, NFTs. Are we in a mania bubble now? Many people believe we are. I think with regard to doesn't mean I'm right, I'm old-fashioned fuddy-duddy. If you see the headlines, if you don't know, if you don't get into cryptocurrencies now, Bitcoin's going to be $1 million a Bitcoin, and I just shake my head and say, why? No, why? Just because you say it's going to be that way? What are the fundamentals? But again, these people don't look at the fundamentals. They're not interested in the fundamentals. They don't care about what kind of income is coming from the thing, or what markets they're moving into, what products they're creating, who are their competitors. They just go, okay, this one's next because Elon Musk just said that. Yeah, okay. Slide number 11. How do most manias end? Well, yes, you guessed it. They invariably end with a crash, also known as a panic. The bigger the party, the bigger the hangover. Look, they're not fun, folks, but the odds are you will live through at least one major crash during your investing career. With this many strong years, I have the concern that there are a vast majority of companies that are significantly overvalued on a long-term basis. Now, who said this? This was John Lovelace. He was the gentleman most responsible for the growth of the Capital Group, which is responsible for the parent company, the American funds. And he said this in August 1999. At the time, he had about 49 years of experience. He said this in August of 1999 when every day a new .com company was coming out, and the price would be $15 and it would start selling at $90, the Globe.com and drcoop.com and CMGI. You've never heard of any of these unless you're old like me. Nobody listened to this guy. He's all washed up. He's a fuddy-duddy. He's gone. Get rid of him. And indeed, he retired a year later in 2000, just as the bubble started to crash, just as the bubble started to deflate and the market started to crash. Yeah, it took about 2.5 more years for people to realize how smart Mr. Lovelace was. Oh, by the way, the 2008 and 2009 market crash was not caused by a stock market bubble, although stocks were pretty expensive. That's not what caused it. It was the real estate bubble and the mortgage-backed bonds that were tied to the real estate mortgages that we'll discuss when we get to bonds. Not James Bond, not Barry Bonds, but bonds. Boring bonds. Stodgy bonds, reliable bonds, unless they're backed by mortgages where the person said they were making $100,000 and they were really making $30,000. Liar loans. So let's take a look at slide number 12. The 13 worst days of the Dow Jones Industrial Average. And there's something to be said right away. The first thing we want to see is, let's get that pointer going. Oops. This mouse is too darn sensitive. What you see here are 2 days in 2020. And those were COVID related. So we really should just throw them out. That had nothing to do with the markets. That was the pandemic. So we're left with, say, 11. And out of those 11, 6 are in October. later October. One is in early November. So 7 out of 11 days are all bunched up in one little area of the year. Well, why is that? There's a lot of reasons. They call it the October effect. There's a lot of reasons that are brought forth, and none of them are very good, in my humble opinion, except for one. There's no way to prove it, but in my humble opinion, we are still animals. We are still ruled by nature. And although you live in a climate-controlled cocoon where you press a button, flip a switch, and when the fall comes, there's a reason why we call it the fall, and the leaves turn and fall to the ground, and the crops die, and the light starts to fade, it gets colder, the days grow shorter, and the nights grow longer. We start panicking. We know that at least 1,000 years ago, 100,000 years ago, there's going to be a whole lot of us that aren't going to make it through the winter. And so it spills into our modern society. There's no way to prove this, but it's my story and I'm sticking with it. So that's why September and October are the two worst months of the year. And you might say, well, why isn't it December? Wouldn't it be more December? No, that's when, 100,000 years ago, we saw the light start to come back. That's the birth of the light. So that's why the Christ child his birthday is celebrated in Christmas time, because Jesus was the light of the world, or is the light of the world, according to individuals. And so that's why All Hallows Eve, Day of the Dead, Halloween, All Saints Day, All Souls Day, that's why they're in late October, early November. Think about it. And if these symbols are somewhat piquing your interest, there's a wonderful book called The Hero with 1,000 Faces by Joseph Campbell that, if you're going to read one book in your life, it's the book you should read. And if that doesn't pique your interest, it's the book that George Lucas used to write Star Wars, to create Star Wars. And Disney stole from them a whole bunch of times. Like The Lion King is basically The Hero with 1,000 Faces. So check it out. Slide number 13. And let's now turn to investor psychology. Investor what? Psychology, the study of psychos? I prefer to call it slycology. In 1962, there was a brief recession and a sharp market downturn. The president's chief economic advisor was giving a presentation to many of the political and economic leaders of the time, describing what they were doing to right the economy. One of the attendees asked, "So when is the stock market going to recover?" The advisor curtly responded, "I'm an economist, sir, not a psychiatrist." Because of the tremendous amount of money involved in the markets, much research has gone into trying to understand investor psychology. And some of the research is very revealing about who and what we are, not only as investors, but also as a species in general. You might have heard the old Wall Street saying, there are 3 factors that influence the market: fear, greed, and greed. Greed usually wins out. Not always. Sometimes we're ruled by fear, but you hear people say fear and greed. I say, no, it's fear, greed, and greed. Yeah. So here are some common investor weaknesses. Reading too much into the recent past. And Andrew Tobias said it best when he said, beware the permanent trend. Permanent trend? There's no such thing as a permanent trend. That's an oxymoron. Even though there are countless examples of investors getting on the bandwagon, just as the wagon was about to veer into a ravine, we trick ourselves into believing, oh, it's different this time. It's a new era. The old ways of valuing investments are gone. Do any of you remember eToys, theglobe.com, pets.com, drcoop.com, all the .com companies? No, one is still around, amazon.com. Would use, that's the thing. You knew 1 or 2 of these companies was going to explode, but you didn't know which ones. CMGI, there was an interesting company. They basically didn't do anything, but they just were associated with the internet, and so they made the stock went skyrocketing, only to become worthless. How about condo conversions in 2006? Some of you don't remember that. Some of you do. Oil in mid 2008 when it went to $147 a barrel, and people were asking me, why is oil so expensive? Why is gas so expensive? And I said, well, do you want the price of oil to go down? You want the price of gas to go down? They said, yes. I said, stop buying it. I said, what? What do you mean, stop buying it? I have to have it. I said, well, shut up. Pay demand. It's supply and demand, right? The reason it went so expensive is because we were buying it. But I told the same people, don't worry. There are folks right now, as we speak, running out there and getting these old oil wells working that, print 15 gallons and 15 barrels a day. Who cares? At that price, it makes sense. Do it. And sure enough, within 8 months, the price was down to $39 a barrel. Gold, 2012. In a few years, I am sure we're going to be adding cryptocurrencies, these SPAC things, whatever they are, boosted by celebrities. That's going to end badly. NFTs, meme stocks. Yes, I think we will hear those. And now we misperceive randomness. Even though stock price movements in the short term are random, we know this to be true. We've already proven it statistically. Our brains will trick us into seeing a pattern. We humans are heuristic, which means we look for patterns, even if we know that they aren't there to be found. For example, in a series of 1,000,000 random digits, the probability that one digit will be repeated 13 times in a row is essentially 100%. So in other words, if you had a list of 1,000,000 random digits and you didn't see one digit, doesn't matter which one, but any one of the digits repeated 13 times in a row, you would know that that's not a random series of numbers. Somebody fudged it. But of course, if you came across that 13 sevens in a row, you would say, this isn't random. Yeah, it is. We're looking for some kind of pattern, even when we're told there's no pattern to be found. And in my humble opinion, this is where technical analysts are guilty of. This is the fatal flaw in their thinking, in their logic, that we've already shown. No. In the short term, stock movements are random, but they say no. Look at this. This is not a random. There's meaning in this pattern, and so we'll see that in our next chapter. Being overconfident. Well, this is true, folks. We're always optimistic about things. We believe we know more than we actually know, or we believe we're better than most other investors. No. The truth is we only see the tip of the iceberg with regard to what is happening within a company, an industry, the economy, and we are usually only average or mediocre investors at best. Especially if we decide to become traders, because then we're up against resources that we can't even fathom. You hear people talk about the reason the Second Amendment is here is because if any country invaded, the citizenry would rise up. Yeah, that worked in 1787 when the average person had a gun that was basically as good as the army's guns. Right? Your gun and their gun was basically, you can't even imagine how outgunned you are. No pun intended. And that's the same thing is true when you go against the modern army. You got your I got my assault rifle, but they got tanks and bazookas and jet fighters and right, and cruise missiles that can knock on your door before they blow up your house. So when we decide to become traders, the same thing happens. We're up against forces that we have that are unimaginable to the average investor. So there's a name for this. It's called the Lake Wobegon effect. If you ask people, if you get a group of 100 people, Are they an excellent, good, average, fair, or poor driver? Usually at least 80% will say they're excellent or good. Now, wait a minute. That can't be right? Where are the average and the poor and the fair and the poor drivers? It comes from the mythical town of Lake Wobegon, where all the women are strong, all the men are good looking, and all the children are above average. They can't be all above average because that's us. We're overconfident. And then one of the things that we investors do is we sell our winners too soon and we hold on to our losers. It's called loss aversion. There's a wonderful book called Thinking Fast and Slow, where two psychologists started doing research many years ago. And one of them passed away, sadly, before the other one won the Nobel Prize. And their research spilled over into economics, and they didn't win the Nobel Prize for psychology; they won it for economics. As humans, we hate to admit we made a mistake, so we stubbornly hold on to our losers, hoping that they will at least get back to where we bought in. The reality is that our memories are wired to forget unpleasant experiences. If you sell your losers, you're going to quickly forget about them. You hang on to them, and then every time you look at your portfolio on the screen, you're going to go, oh. In contrast, hanging on to your winners is what makes an investor rich. But typically, people say, oh, I got that one little pop. It went up 25%. It's time to sell. There's a wonderful story by Peter Lynch when he was asked what his worst investment was. He said, when Home Depot came out, I bought it and it went up 100% and I sold. And everybody, what? Mr. Lynch, that was your worst investment? He says, yeah, it then went up 20-fold. So hang on to your winners, but remember, keep doing the research and reevaluate regularly. Has the story changed? Yeah, stocks for the long term. Okay. Now, let's revisit index funds and passive management and how it relates to manias and crashes. If you recall, passive management index funds rely on indices. Instead of trying to beat the market, just buy the market and be happy with the market return. This is what the efficient market theorists tell you to do. But as we saw, manias and crashes occur. Sometimes an index can become skewed or lopsided or concentrated in a certain sector or region, especially when they become hot. And this happened. Now, this is a slide that we saw back in the chapter on mutual fund. And you really didn't understand it because you didn't really work with PE yet. But now, hopefully, it's going to make more sense. In the 1980s, this Japanese stock market exploded, just the real estate market also, and it was wildly overpriced. You purchased an index fund that mirrored the EFA, Europe, Australia, and the Far East. MSCI was Morgan Stanley Capital International. I have to remember that, but remember the EFA, which is now being replaced by the All Country World X USA, and fully 60% of it was in Japan. So, Canada, Western Europe, South Africa, some countries in South Africa, Australia, Singapore, Hong Kong, and Japan. And you thought you were getting a broad-based index when actually 60% of that was Japanese stocks with a very high PE of 51.9. Everybody else, all the other people we mentioned, made up 40% of the index with a PE very reasonable of 13. You see what's going on? What happened next? The Japanese stock market lost, I forget exactly how much, went from 36,000 down to 7,000. What is that? That's, 80 some percent or more. Yeah, about 80%. So, not good, right? You thought you were a broad-based index, but you were concentrated in Japan. The same thing happened in the S&P 500 in the 1990s. By the peak of March of 2000, fully one-third of the Standard & Poor's 500 was information technology, the dot-com companies, the telecommunications, computer software companies, with a nosebleed 59.2 PE. Everybody else, energy, healthcare, materials, consumer products, real estate, was two-thirds of the index with a high, but nowhere near as high, PE of 19.3. What happened next? Well, over the next 2.5 years, the Standard & Poor's 500 lost almost 50%, like 49 whatever, point something or other. But the NASDAQ, which is tech heavy, lost over 80%, went from 5,000 down to 11 something, 1170 or something like that. So over 80%. So don't let anybody tell you that index funds are the perfect investment. Every investment has advantages. Every investment has disadvantages. And index funds are no different. Let's take a look at the argument for active management. Today in the financial media, passive management is touted as the better alternative to active management. Look, we do know that index funds have the advantage of very low cost investing. Unless, be careful, your third-party administrator sneaks a high-cost index fund into your 401k. That's why you're going to be the genius, the investment guru who's going to talk to that straight in the face of that big jerk in the three-piece suit and say, why are you charging us this much when you could go to Vanguard or Fidelity and get an index fund for far less? And your colleagues are going to be so proud of you, and they're going to say, where did you learn this? And you know what to tell them, right? But decades ago, dear students, Benjamin Graham warned against any investment strategy that relied on deterministic or robotic decision-making and removed the element of human judgment, which is what index funds do. Stocks get very expensive. Sorry, the index fund has to buy more. And stocks get very, very cheap. Oh well, the index fund has to sell. As with any human endeavor, whether it is athletic competition, the performing arts, or technological innovation, some people clearly perform at a higher than average level. Now, this was a gentleman. He's out of the industry now, but he had 35 years of experience and was one of the people who performed at a much higher than average level. And so right now, dear students, you look at, if you did the bonus assignment in mutual funds, you found that 10 companies in the Standard & Poor's 500 make up approximately 30% of the index. This is out of 500 companies, 10 of them. Now, I'm not trying to disparage these companies. Some are very good companies. One, I think, is way overpriced, personally. You decide. But you're thinking you're getting a broad-based index, but no, 10 companies make up 30%. 50 companies out of 500 make up over 50% of the index. So I don't think people really understand this. And I think that when there's a downturn, especially for these companies with lofty valuations, the parachutes had better be very, very large. So what's the argument against active management? Yeah, you never know when your money manager might drink the Kool-Aid and do something really stupid, like listen to any one of these anomalies, silly theories, and oddities. For example, there are these timing theories that Monday is the best day to buy, or is the best day to sell. I don't remember. The January effect, as goes January, so goes the year. Well, that's true of pretty much any month, because except for September and October, because the stock market tends to rise more often than it falls. The Santa Claus rally, sometimes called the turn of the year effect. If it doesn't do well, if you don't have a Santa Claus rally, they call it tax selling. And then the one that actually does have some basis in reality is sell in May and go away. It's true that the best months of the year are from November to March, April, And the worst times are from May to October, September, October. Sometimes they say October is when bear markets go to hibernate. But trying to short-term trade on that information is just is a fool's errand, because it doesn't always work, right? Sometimes May to October is a good time in the month, good time of the year, good time to invest. The important thing is don't think about when this is the best time to invest. Think about what are the best companies to invest in for the next 5-10 years, in my humble opinion. There's a Super Bowl theory that every year gets trotted out. I don't know why, but it states that if the National League wins, then the stock market's gonna go up, and the American League wins, the stock market's gonna go down. And the weird thing is that it's been really uncannily true. That's the boo doo 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 part. But there are just these incredible uncanny coincidences that have happened in nature, like the consumption of mozzarella cheese and a number of PhDs awarded in civil engineering. And it's a perfect correlation, but has nothing to do with one another. And that's the same thing true. The Super Bowl has nothing to do with the stock market. Hemlines of skirts, which are when skirt hemlines went up, like in the 1920s and 1960s, the stock market went up. But then when skirts got longer in the 1930s and 1970s, the stock market went down. There's the lipstick indicator, the Boston snow indicator, also called the BS indicator, and the incredibly offensive and misogynistic hot waitress indicator, which we won't comment on, and the aspirin count theory. You don't believe me? Look these things up, folks. I mean, they're there. And then people will discuss politics and the markets. And of course, we know that poly means many and ticks are blood-sucking insects. But the reality is both parties in our system are committed to capitalism. There's some disagreements about the amount of regulation and the like, and taxes and the like, but no, don't let anybody try to fool you. In fact, the truth is, when a Democrat has been in the White House, the markets have done better than when a Republican is in the White House. Now, the difference over the long term is very small, and much of the difference is because of just dumb luck. Hoover, 1929, Nixon, 73, 74, Bush in 2000 to 2002, and then 2008 again. Whereas some of the Clinton walked in just at a time when the markets exploded. Kennedy, Johnson, and Obama walked in at one of the worst times in the history of the markets, and so he looks like a genius. No, it's dumb luck. Over the long term, both parties are very committed to the capitalist system. Now, let's take some time and take a look at some all-stars of investing. Because I always believe if you want to learn to do something well, watch those people who are doing it, right? Learn from the people who know what they're doing. And so this is something that we could spend a long time discussing, their careers and the like, and you can read about them because they're awesome people. Peter Lynch, we've discussed Mr. Lynch at length. He wrote a wonderful book called One Up on Wall Street. You should read it. Yes, you should. It's very easy reading, and he's got a dry, droll sense of humor. He says, look, buy what you know. You may wear Nike sneakers, right? You know them. Maybe they're a good company to invest in. Maybe they're not. He got some people criticized him for saying you should buy what you know without doing any research. And that's not what he says. He obviously, they didn't read the book, but he wants you to understand the company you're buying. And the same thing is true for Warren Buffett. He says, look, don't buy a stock, buy a company. He puts the emphasis on the value of the entire company. And he says, if you could own this company, if you could own the Home Depot, I mean, if you had the $100 billion it would take to buy Home Depot, and you would do it, go ahead, buy 10 shares, okay? Because you're buying a company, not a stock. Benjamin Graham was Warren Buffett's teacher, and he's often called the father of value investing. He wrote the wonderful book, The Intelligent Investor, that you're going to read eventually. Don't make it your first book, because, as I said, his prose is a little opaque, a little flowery at times. And what's cool is that after every chapter, there's a commentary by Jason Zweig. That is your lifesaver, because then Jason Zweig, who's a wonderful writer in his own right, explains this is what old Ben was trying to say. Okay. He also wrote another book called Security Analysis. That's something down the line. That's more graduate level. But much of the things that they discussed in there, we've learned in this class, dividend discount models and the like. Sir John Templeton, one of the first mutual fund managers to invest globally, and was knighted for his philanthropic efforts. Pretty cool for a kid from a small town in Tennessee, right? And then Bill Miller. Poor Bill Miller. Don't feel so bad for Bill Miller. He was the fund manager of the Legg Mason Value Trust, which we highlighted back in our chapter on mutual funds. For 15 calendar years in a row, he beat the S&P 500, an unprecedented record. He became, unfortunately for him, as far as I was concerned, the financial media's megastar. I mean, he didn't appreciate it either. You got this 10,000 watt spotlight trained on you. How are you supposed to work with people listening to every single word you have to say? But then what happened is he didn't beat the S&P 500 in 2006 and then did pretty badly in 2007 and 2008. He seemed to turn himself around in 2009, but then trailed badly in 2010 and 11. It's a tough business. He retired from Legg Mason in 2012. I was surprised they let him stay as long as he did. He's still involved in investing, my understanding, so look him up. But people, when he was on his tear and we were studying him in these classes, they said, "Why don't you invest with him?" I said, "Well, he's too concentrated for me. He would hold about 40 or 45 stocks, which is great if you're in a team of investors in a mutual fund where you have 7 or 8 mutual fund managers and they all have their own 30 or 40 stocks that they're interested in, because then you wind up with 150 or so, 200, and then you get true diversification because people are concentrating in the areas that they understand and know, but because you got 7 of them, you got plenty of diversification. And that's what happened to him. While his style was working, it did really, really well. But then when it didn't, it did really poorly. And that's the problem with concentration as opposed to diversification. So, what do all these people have in common? They have courage to not follow the crowd. The conventional wisdom is usually not very wise. They have what I like to call an eye for unrecognized value, almost like a sixth sense. They see what others don't see, right? And they are able to say, there is value here that others don't see, and I can take advantage of that. At one time, this was back in the late 80s, early in the 90s, Garry Kasparov and Anatoly Karpov were the 2 best chess players in the world. And so they interviewed Garry Kasparov and asked, why are you and Anatoly Karpov the 2 best chess players in the world? His answer was astonishingly simple and direct. We attack better than anybody else, and we defend better than anybody else. You see? If you can do it, great. These people, these investors bought the best companies, and at the same time, they avoided the worst companies, offense and defense. Speaking of avoidance, as a mutual fund investor, which I mostly am, I am not looking to find the next Peter Lynch or Bill Miller or Warren Buffett. No. I'm looking to avoid the next Charles Steadman. And you might say, well, who is Charles Steadman? Look him up. He's infamous. He ran his own mutual fund, the Steadman American Industry Fund, from December 1959 until his death, thankfully, in late 1997. His cumulative total return during the largest growth spurt in the global economy in the history of the world was minus 42.9%. He would have done much better simply placing his investors' funds into a savings account at a bank. He would have done much better just putting it in a mattress. I don't know, maybe he came from the life insurance industry. So, do you understand? I don't have to win big, I just have to win. I don't want a big loser like Charles Steadman. And luckily, there are not that many out there, but they're there, so do your research. So, let's hear what some of these all-stars of investing say to us. Warren Buffett says, he's famous for saying this, be fearful when others are greedy. Be greedy when others are fearful. So in other words, when everyone's saying, ooh, is it too late to get in? Okay, look out, it's too late to get in. But when they're saying, ooh, is it too late to get out? Then that's the time to invest. And he's just channeling his mentor, his teacher, Benjamin Graham, who said it in The Intelligent Investor this way. Buy when most people, including experts, are overly pessimistic and sell when they are actively optimistic. Sir John Templeton said it this way. Bear markets are born of pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy. On a similar note, he also said, to buy when others are despondently selling and sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, did Sir John listen to his own advice? Oh, yes, he did. World War II breaks out. What does Sir John do? Calls up his broker and tells them to buy every stock on the New York Stock Exchange that was near bankruptcy, selling for less than $1. There's various versions of the story. Look them up. Nazi Germany has taken over the world. Japan has destroyed 1/3 of the Pacific Fleet. And Sir John, he wasn't a knight yet, a kid from a small town in Tennessee, is buying every bankrupt company he can find. 4 years later, he's a very wealthy man. Would you have had that kind of courage? I don't know if I would have. Yeah. So let's end. How are we doing for time? Not bad. My apologies. You can always break it up into pieces. My apologies. Famous myths and stupid sayings. And these are mostly, we've taken most of these from Peter Lynch in his book, One Up on Wall Street. It can't go any lower. Oh, yes, it can, right? Okay. Once it hits zero, then it can't go any lower. Until it hits zero, yes, it can go lower. It can't go any higher. Oh, yes, it can. This is what people used to say about companies like Procter & Gamble and Philip Morris selling cigarettes. If the earnings are continuing to grow, there's no limit to how high the price can go. It's only $3 a share. It's only 30 cents a share. It's only 3 cents a share. What can I lose? Everything. It doesn't matter how low the price is. The price can go to zero. You can lose all your money. Remember that the price, for the most part, is irrelevant. Look at the market capitalization. Look at the valuation compared to what the company is producing in goods and services. What's their future like? It has to come back. No, it doesn't. Companies disappear and become part of history. Anyone ever heard of Penn Central, the largest railroad company? Been in business over 100 and some odd years. The largest bankruptcy of its time. And there have been bigger ones since then, but it was 1969, 1970. And Ben discusses the bankruptcy of Penn Central in detail in his last edition, the 1972 edition of The Intelligent Investor. But it reads just like the bankruptcy of Enron and the bankruptcy of other companies. The technology changes. We are humans. We change very slowly. It's always darkest before the dawn. Oh yeah, well sometimes it's always darkest before it's pitch black. When it rebounds to $10, I'll sell. Now I understand this one. This is that loss aversion. You bought it at 10, it's now at 6 or 3. And you don't want to admit you made a mistake because we humans have a loss aversion. So we'll stubbornly hang on to it. Bad idea. If you wouldn't buy it now at $6 or $3 or whatever it is, it's time to sell because you made a mistake. And you're going to make mistakes. You have to be ready to accept that. Remember, the major league hitter, if they strike out 7 times out of 10, that's average, right? That's good. That's better than average. They're going to, if they hit 300, if they hit three times out of 10, they're going to do really, really well. And you're going to do better than that. You use the techniques we've learned in this class. Keep your eyes open. You're going to do better than bat 300. I can promise you that. Unless the world ends, in which case all bets are off. If it goes down 10%, sell. Now, I understand this logic. They're trying to keep you from having large losses. So that's what the traders will do. They'll have a stop loss. But the problem is stock prices fluctuate greatly. Even blue chip companies, even well-established companies. Look what happened to FedEx, right, just a few weeks ago. If you sold each stock that lost 10%, you would almost always sell your winners along with your losers. So hold on to those winners, get rid of the losers. It is taking too long. Well, now this is something that people do get frustrated with. But that's why we've always tried to get people to understand that it's a long-term marathon, not a short-term sprint. And so that's why they run to the cryptocurrencies and the NFTs and the SPACs, because they want to get rich fast. And I wish them tremendous success and a whole lot of luck, because they're going to need it. Look at all the money I lost. I didn't buy it. Right. You didn't lose a cent by not buying a stock that did well. Don't fret over it. I missed that one. I'll catch the next one. The problem is the next one rarely makes it in that industry. Is there going to be another Microsoft on the PC? No, because that industry is sort of fading now and it's taken over by cell phones. Is there going to be another Google? Microsoft has thrown a ton of money into Bing, but so far they haven't taken Google. Is there going to be another Facebook? No. Buy Microsoft, buy Google, buy Facebook. Don't buy Facebook. They're an evil company. The stock has gone up. I must be a genius. No. Never mistake a bull market for brains. That's an old Wall Street saying. The stock has gone down. I must be an idiot. No. You're not an idiot. Sometimes companies do badly for something totally unrelated to what had to do with the company and your research. So you just have to be ready to accept that. In fact, professionals that have started when the market was challenging say that was better for them in the long term. It taught them humility and it taught them challenges. Whereas people who started as the market did its upswing, they say, you know what a bad deal that was. I thought I was invincible and I just kept pouring on risk, and then Right. Markets go through cycles. And then finally, slide 31. It's different this time. Oh, yeah. Well, technically different. Every day is different. But that doesn't mean you should pay an astronomical price for a company that probably will never make $1 worth of profit. That's what the internet stocks were like. It doesn't mean you should buy these cryptocurrencies, which have essentially no value, because they're not backed by anything except from some algorithm that somebody made up. It's a new era. It's a permanent trend. When you hear these three together, it's different this time. It's a new era. It's a permanent trend. Quick, they're giving away free money. Run down, get yours. You know that you should be fearful when others are greedy. And then when they're fearful, you be greedy. And then lastly, you will hear people say, especially when they find out that you're invested in stocks or you're taking business 123, stocks are too risky. And you have to acknowledge the risk. You have to make people understand that, yes, you're right, but even with all the shenanigans and stupidity and silliness, they are still the best long-term financial investment. Yeah, I think so. And you are now full-fledged investment gurus, and you speak with authority, and you don't forget to recommend Business 123, Introduction to Investments, okay? And that is our discussion of market efficiency theory, who can beat the market, investor psychology, AllStars of Investing. As always, thank you so very much for being in our class, and I apologize. I went a little over I thought I would. But it's fun. It's a little bit of silliness involved and a little bit of stuff that it's actually useful to us, I think. So go back over and do it in pieces because we finish stock education, our stock journey next week, next chapter with technical analysis, reading squiggles on a screen. Right? I'm not a big fan of technical analysis, so you got to find somebody else to teach that chapter, but I'll do my best. Okay, so thank you so much for being in our class. All of us at Southwestern are incredibly honored, privileged, happy, and grateful you're with us. Think about how much you've learned. Study every day. Bring honor and glory to your family, your friends, your coworkers, and yourself. See you in our next chapter on technical analysis.